Well, let's get across the market open. Mark Gardner joining us from MPC Markets. Mark, happy Monday to you.
Happy Monday indeed.
Potentially happy day on the market where SPI futures indicating we're at about more than 1%. Mind you, that's off the back of Friday's steep losses.
Well, yeah, Friday was a pretty horrible close. I think it was the fourth weekly loss in a row. I'd expect the market open to be very positive. You've got BHP, a bit of confusion around that, saying that there was a bid for Anglo-American still, and now saying there's not. So that should be, I would say that's relatively positive for BHP, share price overall. And then Pro Medicus as well, which is an increasing part of the index, has announced another $30-odd million in contracts as well. They've been a little bit quiet lately, so I think shareholders would be really happy there with the share price down in those mid-200s. Might see it head a little bit higher. But overall, I think copper was up a little. Iron ore was largely flat. Gold and silver going nowhere. But we did have the Fed Williams on Friday night essentially go against what a lot of the Fed speak has been in the last sort of probably 7-odd trading days, and say that essentially, he's open to a rate cut potentially, that rates are possibly restrictive at the moment. And he sees that inflation is taming and the job market is worsening. So that brought rate expectations from around about 20% chance of a cut, which is down from 50% earlier in the week, all the way back up to 70% chance of a cut on Friday night, which really did send the broader market higher. And I think you can see the small caps index, the Russell 2000, was actually up 2-odd% on Friday night, and was the best performer across the board. Wasn't really lifted by tech this time, this rally overall, because we saw Nvidia still lagging a little bit despite hope that they're going to be able to sell into China.
Technically, where are we at when you look at both what we're seeing on Wall Street and also here locally on the indices, particularly in reference to the 200-day moving average?
So the Australian 200-day moving average, we're around about there at the moment. So we need to probably see a bounce out of here quickly. We're going to get a portion of that today. But realistically, the only other, we use an average of about 14 or 15 technical indicators, and on a hourly, daily, all of the indices in the US are at a strong sell at the moment. The only two positive indicators are that it remains above the 100 and 200-day moving average. The 100-day is very close. A breakthrough there would possibly see some knock-on selling. The 200-day moving average is quite a way away, so it'd be, it would be quite a move to get down to there. But I think we're going to get PPI data this week out of the States, core PCE data as well. They're both tentative at this stage, just what the BLS can get through. We've got our CPI here on Wednesday as well. So I'd probably be thinking that this is a pretty key week technically for the market. If we can get a rebound here, this may well be the dip. But if we fall further and that technical momentum significantly shifts to the sell side, or even further than what it is now, I think we're going to potentially have an ugly end of year. So.
Do you think we're due for a correction? I mean, given there's been a lot of speculation building up to this, obviously talking about the stretched valuations both here and on Wall Street.
Yeah, I mean, look, my general opinion is that the AI thematic is absolutely 1,000% real, but the market has gotten a little bit carried away with it essentially, and I think we are due for a dip, because I don't think we're going to see the revenue come through that is needed to justify. There are some questions around Nvidia's earnings as well, in terms of, they've got a very large percentage of the chips they've sold that no one's paid for yet. There's questions around the depreciation from all of the Mag 10 firms, that they're buying these chips and depreciating them over far longer time frames than they're actually their use cases for. And there are some questions around how long this can last. But overall, I think any significant dip, you'd be buying into those hyperscalers, particularly the Googles and the Microsofts and the monetizers of the world. Yeah, and look, it's been an incredible run. It's the best 6-month run in this. I bounce out of a bear market in history. One of the best 3-year rallies in 30 odd years. I mean, I think we are due for a little bit of a pullback. I dare say the catalyst will be, there's a lot of talk around layoffs in the US. You've got numbers ranging from 300,000 to 170,000, in that October. And whilst that payrolls number was okay last month, that was September. And none of the layoffs really did start, none of the layoffs started until October. So we'll just be interesting to see what comes out of the BLS and the payrolls numbers over the coming weeks.
And Mark, locally obviously dominated by the resources sector, the volatility of those underlying commodities is quite extreme at the moment, isn't it? In fact, just more recently, lithium's been doing well, and then the price came off dramatically.
Well, and uranium had the similar story. It went on an absolute heater of a run and has peeled back in the last week. But that tends to be the case in commodities. I mean, they do tend to go on extreme runs, and I think the lithium sector in particular was coming off such a downtrodden, and like that was some of the short. We're talking about two sectors, uranium and lithium, that were probably the two most shorted sectors on the ASX. So that recovery and that bounce out's also fueled by short covering as well. But they're probably around about fairish value now, maybe a touch expensive. They probably need the thematic to continue, but overall, they were very, very low. And probably very cheap, at those levels about 2 months ago.
So, are you tinkering with your portfolio at the moment? Have you sort of taken more of a position in cash? How are you playing it?
We're definitely in more cash. We're about 30 to 50%, depending on the risk profile of the client overall. But more so, not being particularly bearish, but basically saying the value of cash, if there is a dip, will be super advantageous in being able to go and pick up some of those those high quality names, not just in the ASX but in the US. And at the moment we just don't see I don't see us pushing back through record highs at this point. I think the technical momentum was the only thing really holding this up. On the fundamental side, we've had there's a lot of questions around the market. So cash is a position too, and it's not, as I say, it's not being ultra bearish, but it's just being a little bit patient and banking a very good run over the last particularly over the last 6 months, and keeping our options open for the future.